September 16, 1992. A Wednesday morning. Somewhere in London, a mother was preparing breakfast for her children before school. A factory worker is clocking in for his shift. A young couple were nervously checking their mortgage interest rates, hoping they would remain manageable. None of them knew what was about to happen. None of them knew that today, their government was going to lose, and badly, publicly, humiliatingly. And they didn't know that a man, sitting in a quiet office in New York, sipping coffee, watching numbers on a screen, would walk away with nearly $2 billion by sunset. His name was George Soros, and this was the day he broke the Bank of England. But to understand how one man could destroy a nation's currency in a single afternoon, you had to go back. You have to understand the world that made this possible, because Soros didn't set the trap. Britain walked into it willingly, eyes open, smiling. It's 1990. Europe is changing. Fall of the Berlin Wall has already happened. Germany is reunifying. There's a dream moving through European capitals, a dream of unity, of a single European identity. And part of that dream is economic. Countries begin tying their currencies together through a system called the European Exchange Rate Mechanism, ERM. On paper, the idea looks elegant. Every country agrees to keep its currency within a narrow band against the German Deutsche Mark. If your currency rises too much or falls too much, your central bank steps in and corrects it. Stability, predictability, a foundation for future European integration. Britain joins in October 1990. Prime Minister John Major is proud of the decision. The pound enters the ERM at 2.95 Deutsche Marks. It's a high rate. Some economists immediately say it's too high, that Britain is overvaluing its currency, that this will cause problems. But those economists are ignored. Fast forward 2 years. Britain in 1992 is not doing well. The economy is sluggish. Unemployment has climbed above 2.5 million. Manufacturing is struggling. The housing market, which had boomed in the late 1980s, is now collapsing. Families are trapped in negative equity. Their homes are worth less than their mortgages. Repossessions are rising every month. Normally, the response to this kind of economic pain is simple. You cut interest rates. You make borrowing cheaper. You bring life back into the economy. You allow your currency to weaken slightly so your exports become competitive again. But Britain can't do any of that. Because of the ERM. Because of the promise they made to Europe. To stay within the exchange rate band, Britain has to keep interest rates high enough to make the pound attractive to investors. So while the economy is crying out for relief, the government is holding interest rates at 10%. Ordinary people, homeowners, small business owners, anyone with debt, are being crushed. And the government's hands are tied. The pound is sitting at the bottom of its allowed range. It wants to fall even further. The Bank of England keeps intervening, buying pounds with its reserves to keep it afloat. It's like trying to hold a beach ball underwater. You can do it, but it takes constant effort. The moment you get tired, it shoots back up, or in this case, straight back down. George Soros grew up in Budapest, survived the Nazi occupation using false papers, and escaped communist Eastern Europe after the war. He eventually moved to London, then New York, and built one of the most successful hedge funds in history, the Quantum Fund. Soros has a theory he calls reflexivity. The core idea is that markets are not rational. Prices don't just reflect reality, they shape it. If enough people believe something, it becomes true. A currency people believe is overvalued becomes overvalued, because enough people act on that belief. By the summer of 1992, Soros and his chief strategist, Stanley Druckenmiller, had been watching Britain for months. The numbers were clear. The pound was fundamentally overvalued at its ERM level. Britain's economy could not sustain the high interest rates required to defend it. The government was running out of political will. The Bank of England was running out of reserves. And most importantly, they were not the only ones who could see it. One day, Druckenmiller went to Soros and said he wanted to take a $1.5 billion position against the pound. He was betting it would fall. Soros looked at him, told him to think bigger. Go for the jugular, he said. Put in $10 billion. Shorting a currency works like this. You borrow billions of pounds from banks. You immediately sell them and convert them into Deutsche Marks or other currencies. Then you wait. If the pound falls, which you believe it will, You buy it back at a lower price, repay your loans, and keep the difference. The more the pound falls, the more you make. The risk is this: if the pound doesn't fall, if the Bank of England succeeds, then you're stuck holding a position that loses money every day. But Soros had done the math. He believed the Bank of England could not win this fight. Its reserves were large, but not unlimited. His credit lines spread across global banks were effectively unlimited. He could keep selling pounds longer than the bank could keep buying them. It was a war of attrition, and he had more ammunition. Throughout the summer of 1992, the position quietly grew. $10 billion, then more. Word began spreading through hedge fund circles. Other funds started building similar positions. Pressure on the pound increased slowly, invisibly, like water building behind a dam. Then the morning of September 16th arrived. From the moment European markets opened, the pound was under attack. It was trading at the bottom of its ERM band. Every time it tried to fall further, the Bank of England stepped in, spending billions per hour. Just to keep the currency alive, the government stepped in. At 11 a.m., Chancellor Norman Lamont announced an emergency rate hike, from 10% to 12%, effective immediately. The markets didn't care. Selling continued. The pound kept falling. The bank kept buying. Reserves drained. At 2:15 p.m., a second announcement came. Rates were raised again, from 12% to 15%. An extraordinary move. A rate that would devastate already struggling homeowners. A signal that the government was running out of options. The markets didn't react. Selling continued. In New York, Soros was watching. Everything was unfolding exactly as expected. The government was trying everything, but nothing worked. Because the fundamental problem, that the pound was overvalued and the economy couldn't survive the rates needed to defend it, hadn't changed. The Bank of England was spending roughly £2 billion per hour, and it still wasn't enough. By late afternoon, it was over. Inside the British government, there was panic. John Major called European leaders, asking Germany to cut its interest rates. Germany refused. The pound was Britain's problem. At 7:30 p.m., Norman Lamont stepped in front of the cameras. He looked like a man who had just lost a war. Pale, controlled, but strained. He announced that Britain was suspending its membership in the ERM. The pound would no longer be pegged. It was free. Within minutes, the pound dropped 15%. It was one of the most humiliating moments in modern British history. A policy the government had built its credibility on, gone in a single afternoon. Not by another nation, not by a recession, not by an act of God, but by a 62-year-old Hungarian-American hedge fund manager. In New York, Soros's team ran the numbers. The Quantum Fund had made $1.8 billion in one day, the largest single-day trade at that time. Soros would later call it the trade of the century. He was calm, almost philosophical. In interviews, he showed no guilt, no apology. He said he had simply done what markets do, correct a mispricing. And he was right. That's the most disturbing part of this story. Soros didn't break any rules. He didn't bribe anyone. He didn't hack any system. He didn't do anything illegal. He looked at the structure governments had built, found a flaw, and bet on that flaw being real. He was right. And the system collapsed exactly as he predicted. The families whose mortgage rates hit 15%. The businesses that couldn't borrow. The workers whose lives depended on an economy being squeezed to defend a policy that ultimately failed. They paid the price. This is not a story about crime. This is a story about how power actually works. The gap between what governments say they control and what they actually control. The difference between rules written on paper and the rules that truly govern the world. The system wasn't broken by George Soros. It was already broken. He just had the audacity and the capital to prove it. And that's how real money has always moved. Not in headlines, not in press releases, in the cracks, in the gaps between what is supposed to happen and what actually does. The question isn't whether those cracks exist today. They always do. The real question is, when they open, which side will you be on?